What if I told you that starting 15th January 2025, you could tap into thousands of dollars from your home's equity and lower your monthly mortgage payment all at the same time? And on top of that, add a rental unit to offset your costs. Does it sound amazing, right? Well, with Canada's new mortgage rules, you can do exactly that. But here's the catch. It's not about only getting access to your equity. It's also about using that equity strategically to make sure you're not just paying off a loan, but actually building wealth. I'm here to break it down all for you. Over the next few minutes, we are going to go over step-by-step game plan on how you can make these rules work in your favor, whether it's adding a rental income or reducing your monthly mortgage payments, or even planning for long-term financial success. And trust me, you'll want to stick around until the end because I'm sharing some actionable tips that could save you thousands. Let's dive in and turn this new mortgage rule into your next financial win. Let's go. All right, let's just go over a brief overview for the new mortgage refinancing program that will be effective from January 15th. So homeowners can refinance up to 90% of their property value. The cap here for that property value is $2 million, which is still far enough for a lot of people to take advantage of this. Second, you can add up to 4 self-contained rental units such as basement apartments, in-law suites, or even laneway homes or ADUs, for example. But again, it has to be a legal basement suite, not just a finished basement which you've got your mom and pop friend to help out with. And the amortization, even with 90% of refinance amount, you can stretch it to maximum 30 years. The catch here is CMHC insurance will be applicable, but again, we'll get to that in detail later. But this will give you access to a lot more equity in the house, but also creating rental income for you. This new mortgage program basically is to address the housing shortage and affordability crisis for first-time buyers or investors. But I think what this will do, this will increase the rental supply in the market, thereby making it more easier for investors to pull out more equity and buy more investments, and for first-time buyers also to get into that investment journey sooner than later. Let's look at one scenario where probably you bought a house worth $1 million with only 10% down payment a year or 2 years ago. This is how it will look for you. Let's say your purchase price was for $1 million. You paid 10% down payment, you had 90% of the loan, mortgage insurance got added up for the CMHC, then you could only amortize for 25 years. Now you can do that for 30 years as well, but if you've taken the house a year or 2 years ago, you could only go up to 25. That brings your out-of-pocket mortgage payment to $48.70 a month. Let us consider you're trying to add a basement apartment to that house now. Let's look at what that would look like. Your renovation cost is approximately $80,000. The appraised value of a house after that major reno and a legal basement apartment would be somewhere around $1.2 million from $1 million. You can refinance this as of today, unless the new rules kick in, at 80%. That brings you to about $960 value. Because you are refinancing 80%, you won't be charged any mortgage insurance. But now you can stretch that amortization to 30 years, bringing your monthly mortgage payments to $4,500 or $4,600 approximately. This will now have a rental income as well of $2,000 a month, bringing your out-of-pocket expense at $2,580. But the catch with the new rules is not here. In this scenario, you can only pull out an equity, which is the difference between the existing loan you had and the new refinance amount of about $32,000. And this does not include any additional cost that the banks could imply based on early cancellation or a change of mortgage. Let's see what these new rules will now have an impact in a similar situation. Let's say we plan to do a renovation again for the basement. Approximate cost for that is $80,000. The appraised value is again close to $1.2 million. Now the mortgage insurance element will be added onto your mortgage because your down payment would be less than 10% based on 90% refi. Your refinance loan would be about $1,080,000. Your CMHC insurance will be added about $33,000, bringing your total loan amount to almost $1.12. Amortization is again 30 years. Your monthly payments will be $5,310, and now with $2,000 of rental income, your monthly expenditure would be $3,300 approximately. But what difference does this make? This gives you an equity takeout of almost $185,000. This covers your initial down payment you would have made for purchasing the house, also the reno cost, which we'll look into it deeper in detail. But that's the biggest difference with this new mortgage update. Let's look at different mortgage comparisons before and after scenarios. Originally, when you had a 25-year amortization, you would be paying just around $4,800 a month. After refinancing based on old methods on only up to 80%, your monthly payments will drop down to $4,580 because you could stretch the mortgage to 30 years. But with the new rules, now with your amortization is stretched to 30 years, an extra loan amount that you're able to extract, your monthly payments will go up to $5,300 a month. But your net out-of-pocket payment will still be $3,300, which is lower than what you were originally paying before the refinance amount. Moving on to the next equity and rental income scenarios. With an equity of about $185,000 with the new rules that kick in, also adding $2,000 of monthly rental income, you're in a pretty sweet spot sitting with a lot of cash in your hand and lower monthly payments on the other. You can either use this money for an extra investment or pay down some of your renovation costs that you would have done for the basement, or use this money to invest somewhere else where you could make it grow even faster. Let's look at some of the breakdowns and cash flow. With your initial investment of $100,000 for the down payment, plus considering $80,000 in the renovations for the basement, your recovery amount is still pretty solid. You could take out the entire recovery amount of $185,000 out of this refinance. And also, you still have about $80,000-$90,000 of equity sitting in the house. That 10% is still there. Now, the monthly cash flow with adding rental income of $2,000, we're sitting at comfortably below the $4,600 that we were paying before, to $3,300 based on what we can get for the basement. An average basement right now, if it's a 2-bedroom anywhere around the GTA, minimum is about $1,850, and you could go up to $2,300 as well. Let's look at the impact for the new mortgage rules. With the old rules, you were only allowed to do 80% of the home value appraisals. That means lower takeout for opportunity in terms of cash out. So many people would not do that within the first 2, 3, or even 4 years of owning the property, since the money you were getting out of the refinance was very low. But with the new rules, once you can pull out 90% of the equity again, by increasing the value of the house by adding additional basement or ADUs or laneways, you can actually get more money out of the property in a very short span of time. Looking at the key financial takeaways from this is, again, the equity takeout is $185,000 in this scenario, which I cannot stress more. This is a very huge amount that you can pull out of the property while reducing your monthly payments. Your cash flow is so much better. Instead of spending close to $5,000 a month, now you're only spending $3,200, $3,300. Yes, you're paying more mortgage because you have extended the mortgage, but we can leverage this position by investing the equity in hand to maybe buy something else which can have enough returns for us to cover these mortgage payments that we are making. Our total equity in the property is still around $86,000, $90,000. And with longer amortization, we have more room to play around for next investments. All right, now that we've gone through the new mortgage rules, let's talk about how you can actually use this for your advantage. Here are 3 simple steps to turn these new rules into real gains for your wallet. Number 1, tap into your equity. If you've been thinking about upgrading your property, like adding a basement suite or an ADU, now's your chance. The new rules let you pull about 90% of your home value. That means you can cover renovation cost and still be left with serious cash. Number 2, invest that extra cash. Let's say you are covering your reno, you're left with $120,000 after the reno cost. Instead of letting it sit, use that money to invest into a small condo in the city or a freehold home in the suburbs by leveraging it in the way of a mortgage. Number 3, let your rental unit pay your mortgage. When you add a legal rental unit, a basement, or an ADU, you can cover your mortgage with that extra rent. Imagine reducing your out-of-pocket cost by $1,500 or more every month. That's cash flow for you to use for whatever you need, whether it's paying down debt or saving for your next investment. But here's the kicker. Don't let it just sit in your bank account. Act on it. Here's what you can do right now. If you already own a home, start thinking about whether you can add value to it, maybe by adding a rental suite, a garden suite, or an ADU. Could be anything that you want. If you're a first-time buyer, this new rule means you can house hack by living in one of the units while renting out the other. And listen, don't go at it alone. Reach out to me, let's chat about how you can make these new rules work for in whatever situation you are in, whether it's planning a renovation, calculating potential rental income, or making your next investment. I am here to guide you. And before you go, don't forget to hit the subscribe button and tap the bell icon, somewhere around here, so you don't miss out on more tips that will help you save more money and build your wealth. I'm all about making real estate easy and fun, so let's make 2025 the year you level up your real estate game and start seeing those big wins. Thanks for watching, and I'll catch you in the next one. Take action now. Let's get you closer to your financial freedom.